Hey guys, what's up? Welcome to another episode with me, Shashank Gadappa. In today's episode, I'm going to look at 5 small cap companies that I feel are very undervalued today. And I feel that if I look at it from a 5 year standpoint, they should do really well. Again, none of this is a buy or sell recommendation. I am a SEBI registered research analyst, and this is my research that tells me that these are some very interesting companies you should look at. But why now is because small cap index has fallen quite a bit. I'm pretty sure most of your portfolios, if it was small cap heavy portfolios, you would have bled a lot. My portfolio is also small cap heavy. I have also bled, and this is something that we should be very careful of, right? In fact, I don't know how many of you all know this, but a few months ago, we launched our own small cases, 2 small cases. One was a quant small case, Fluid Q, and the other one was a compounding small case called Fluid C. Now, we were very scared of this because the market has been falling constantly since we launched it. In fact, small caps has been battered, but we ensured that one of the core principles in our small cases, try not to lose money as much as possible, because in the past I have done mistakes, I have lost money. So all of that has come into this small case of learnings. And as you can see right now, the Nifty 50, Nifty 500 is around base value. It has not gone up, not gone down, but we are up around 3% from this index, right? And Nifty is still falling, but luckily we are at a 3% alpha. Why? Because we realized our mistakes in the past and we have changed the position of small cap is less, gold is more, large cap is more. So we have done things like this, right? Even if you look at the long-term compounding basket, which is Fluid C, we have done similar things over here. Again, here it is no loss, no profit right now. It is 100 and 100. So we are maintaining it, but dividends are obviously there. And this is, as you can see, a fairly weighted basket, 40 large, 30 mid, 30 small. Again, please go through it and do your own research before getting any answers to this, right? Awesome. So now the first company that we are going to talk about, again, not a buy or sell recommendation. The first company we feel is very interesting is a company called Tips Music, a small cap company. And by the way, I don't hold any shares in Tip Music. I'm very interested in this, but I don't hold anything as of now. But I find this company very interesting. I'll tell you why. Because if you look at the chart, it went up like this and now it's fallen from the peak. So if you look at the last 5 years, it went up 10x and then it has fallen from the peak from 924 to right now 300 and it's fallen 372 points. So it's fallen down 40% from the peak. Now, first, let's understand why. Second, let's understand why now. Okay. So couple of things. One, the P ratio of this company went up to very alarming levels of Tips, right? So if you actually look at Tips right now, it is at 37p. If you look at it, it's 37p and 7,000 crore market cap company. But in the past, it was almost at 80 PE. Obviously, 80p is not good, and it was sitting at 80p. Second problem this company was facing was because of the demerger from Tips Music and Tips Films. Okay, the demerger happened somewhere around 2020, 2021. And then suddenly the music industry, obviously, it is a huge cash flow generating machine. And I'll show you what I mean by that. So this company suddenly had the cash flow coming in, the sales coming in, and it was growing at a very beautiful pace. 49% growth, 37%, 29%, 28%. But when this kind of growth happens, euphoria kicks in. People started buying it at any valuation, buy at all price, buy at any price. All that happened. Now the management came and said, listen, we can't sustain this. We can't keep growing at 28%. So we might grow at a smaller percentage right now, which is around 20%, okay, or 15 to 20%. That is why the stock took a massive beating. And this time, the result, see, as you can see here, 19%, 10%. But this time the result came about 21% again. Now, Tips is a free cash flow machine player, right? Because they're making money off your music. Anytime you listen to their music on YouTube, they make money. Some movie uses it, they make money. When you remix, they make money. So they're a massive free cash flow machine. And ek bar they make the song's shelf life is around 25 years. After 25 years, they remix that and it becomes another 25 years. So it keeps going. It is an endless cycle, right? As you can see, after the demerger, it's a debt-free company with huge cash flows. And what they have also done is, if you can see in cash flows over here, you can start seeing that they've started paying a very good amount of dividends now. And apart from this, another thing I really love about this company is every year after the demerger from 2020, 2023 and 2024, they have done buybacks and they've given dividends. So when a company is giving crazy amount of dividends, 3 dividends a year and doing buybacks, definitely the management is looking very interesting. Yes, the valuation was very high, hence it was falling. So the promoter still owns 64%, FII, DII holds, and public is 23. And if you look at the returns ratios of this company, the return on capital employed is 109% and 82% because cost ही नहीं है. The cost is the cost of making music. Like they will get not Honey Singh because he's with Tips, but they'll get somebody to make a song and then they'll play that song and then that goes on YouTube. They make money from YouTube views. And as you know, people in India are loving Bollywood music. They will keep loving it. And now they've gone into regional also. So if you actually go through their PPT, you will see how the music industry has evolved. right? And they've just given a phenomenal result. And you see this. This is how the revenues have gone up. And I believe this will continue. Maybe not at the same pace, but if I'm looking at it from a futuristic perspective, I don't care about the pace. Even if they grow at 15%, it is a free cash flow company with insane ROE and ROCs. And usually with a high free cash flow yield, they're known to make good amount of multi-baggers over a period of time. So if you look at the YouTube videos views, so annual views have all gone up, obviously because we are all addicted to these things. New songs added. So the problem is new songs added have gone down, which is why people are not happy. But they are saying, boss, I don't want to simply add new songs. I want to add properly. So that is why this company becomes very important to understand. So from a long-term perspective, answer is yes, sir. The company is very good. From a short-term perspective, volatility might be there, but we are only looking at long-term, and it has fallen on 40% from its peak. And right now, for me, the valuation comfort becomes good because it's back to around 37 PE right now, and it is a free cash flow player, right? So for me, right now, the valuation comfort is decent. Another company I like, which is in the space, is called Prudent. Okay, so again, Prudent is a company that is in the wealth management space. Okay. This is basically a mutual fund distributor app. There are only 2 to 3 players in this space. This is one of the market leaders. So there's Prudent, there is NJ, and there is one more. I forgot the third name, but Prudent and NJ are very good. NJ is even bigger than Prudent, unlisted, not listed yet. Cannot buy it, don't ask those questions. But Prudent is a listed company. And again, because it is a platform play, what they do is they go and attract all these mutual fund distributors, small guys. They don't have a platform. So this guy gives them the platform, says you buy everything from my platform. I will give you the user interface, everything. I will go and tie up with all the mutual funds in the market. You sell whatever you want to your customer. I will keep a small cut from that on your AUM. If I have 300 crores AUM and a mutual fund distributor is making 1%, he might take 0.25% or 0.3%. That is the reason for it. So that means the more mutual fund industry grows in India and the more indirect share, which is a regular share of mutual fund grows in India, Prudent will continue growing. So when you see more and more SIPs coming from tier 2 and tier 3, most of them have mutual fund distributors. They are not like me and you who go buy from, Grow and directly go to Grow mutual fund and buy direct. They buy indirect only. They need help, right? So if you look at this company, in the last 1 year, it has given minus 14% return. And in the last 5 years, it has been doing well. But after that, it has just gone down. From the peak, it has fallen 21%. And obviously, arbitrage kicks in here because again, this company is at 47 P, which is, I would say, okay, not too high, not too low. I would like it to be around 30s. A 9,700 crore market cap company, debt free. And if you look at the revenue of this company, it is only growing. If you look at the profit of this company, only growing. Net profit of this company, net worth of this company also always grows. And it is a free cash flow player. So if you see Prudent, last 1 year, it has given minus 14% return. And from the peak, if you see, it has gone down almost 24% return. Now, whenever this happens, that means arbitrage play comes into the picture. I love arbitrage plays. So when we look at the company, market cap is 9,700. P ratio is 47, which I would say is not great. I mean, I would not say it's very high, but I would not say it's very low. It is high for this kind of a company. Dividend yield is okay. And debt to equity is free. But the beauty of this company, it is a revenue generator. Because as I said, if mutual funds grow, indirect mutual funds or regular mutual funds grow, industry grows, this guy will make money. And he makes money on SIP. Even if nothing grows, and just the mutual fund start growing, he makes money on the AUM. Okay. So if the mutual fund is making more money, this guy makes more money. So revenue is growing, obviously. Profit is almost at 15% PAT, right? So very good company and a massive free cash flow generator. If I show you the net worth, you will see the net worth also good. So debt-free company. And I believe that if I look at it again from a 5-year standpoint, this company again looks very, very, very interesting. Another company that has fallen down is Rainbow. I think this I had spoken about in the past. Now, Rainbow is a very interesting company, healthcare, recession proof, makes babies and takes care of babies, right? It has fallen on 15%. But if you see from a long-term perspective, it has always been a grower. But again, I'll come to why it has fallen down from the peak, almost 25% drop from the peak for a couple of reasons. Rainbow is a company that is very good, specialty in child. And there was a study that came out by Avendus that said that in the future, multi-speciality will not make more money, but single specialty will make money. Hence, Rainbow, HCG, all of these companies are doing really well. Now, if you look at Rainbow, they are very heavy in Bangalore and Andhra. And Andhra is their main base, okay? But why it is falling right now is because when the interest rates are low, usually hospitals go and either acquire companies or get hospitals done or build new hospitals. Rainbow has taken a very weird stance and they're saying we do not want to build more hospitals. We want to go slow right now. So we are not going aggressive. When the whole market, your Max, Apollo, everyone is going aggressive, they're not a specialty for children's birth, but they don't want to go aggressive. And because of that, everything starts looking sad. The narrative starts looking bad. And because the narrative is looking bad, the stock fell 25%. Did it affect fundamentals? Absolutely not. Fundamentals are growing, right? Debt to equity 0.54. They want to reduce their debt even further before going ahead. So if you again look at it from a 5-year standpoint, great. If you look at it from today's standpoint, narrative is bad. But this is one of the good hospital chains that are there, run, managed well, professionally managed, but only not aggressively expanding. And ideally, in this competitive space of hospitals, we want companies to expand aggressively, and that is not happening. Okay, so again, this is very interesting company. Coming and look at the EV EBITDA of this company, you want to check, we can check the EV EBITDA because that is how you value companies. So if you look at the EV EBITDA of this company, it's 23. So that means it's quite attractive. Usually the industry ratio is 32, but this is 23. So it is quite attractive and looks very interesting. But only thing, they're not growing fast enough. And because they're not growing fast enough, people are not enjoying this company right now. See, their debt also went up because they did it in the past. Now they want to clear their debt and do that. So that is why they're not growing very aggressively, right? Now, coming to another company, last company of today is a company called Indegene. Okay, this is again a very interesting company if you haven't read about it. Now, we have IT companies. All of us know IT companies by default are good. IT is also one of the sector that has given the most multi-baggers in India from their nature of being free cash flow. So IT, pharma and chemicals are those three sectors that have, and banking, four sectors have given good returns in India and will continue to give multi-bagger returns in the future, right? So Indegene and one more company is called IKS. IKS is not fallen down like this, but Indegene and IKS are in the healthcare IT space. Okay, they only do IT in healthcare. And they do it for US and European and North American companies. Okay, so Indegene is one such similar company. If you see, they've fallen on 27%, right? From their IPO time, they've not done great. They're down 27%. So if you look at Indegene's exact understanding, right? It is a digital first healthcare and technology company and helps biopharmaceutical companies. They basically do services like how your TCS does for BFSI. They do some specialized services for all the companies in US. So when a person goes and visits a doctor, let's say there's a patient that visits a doctor, they have models that has the entire software is there. So they log the patient, they find out his history, all of that they basically do. They even call, they check, all of those things. They do a lot of things, right? So they do marketing and sales for them. They do regulatory and medical affairs, pharmacovigilance, R&D. Beautiful IT company. And you can see that with the ROE and ROC is also pretty high. And P ratio has come down to 25 for this company, which makes it come in my radar that, okay, this is interesting. Let's keep an eye out on this. Obviously, never catch a falling knife. But as soon as the falling knife starts becoming a urta hua tir, we will take it, right? I mean, bad example, but yeah. So if you look at the revenue of this company has gone from 1,000 crores to 3,000 crores. So 5 years mein 3x. Profit has also gone up. Net worth also goes up. They are a pretty good cash flow company as well, right? So they do make good amount of cash flow. If you look at their PEG ratio is also 0.87. So it is also good. Market cap to sales is what you look at. IT, 8 is the highest. 3.76 is very far from the highs. And as you can see, they're an insane free cash flow company. Last year, they made 400 crores. Before that, they made 1,400 crores. So whenever a free cash flow company comes into our radar, we only look at whether this is sustainable or not. And can they grow at a similar pace? Right now, they're growing at a very bad pace because of US tariff, 100 problems. But once I think all of this turns around, this company can look very interesting, right? Only problem is the promoter holding was low. I mean, it is not even there, but it is all in the promoter holding is here basically. So they have not actually done it as promoter, but 21% is owned by this company, right? If you don't like this, another company that is interesting but has not fallen so much is IKS. As you see, the premium is very high. 10 times market cap to sales is also high. Everything is high. But this is another company that has not fallen down so much. It is pretty much flat over there. This is a company that is owned by Rakesh Jhunjhunwala. Again, this company is an insane company. Look at the growth. Complete free cash flow company. This also. Look at this, right? Superb company, similar space, similar stuff. they also do something similar only. So basically, these were the 4 to 5 companies that we are looking at right now. They're very interesting. Obviously, it is not a buy or sell recommendation. I want you guys to go do your own research about this because they are very interesting companies and they're sitting at very low premiums right now. So if you are smart, you can do your research and you can take your arbitrage play on that. Please understand, small cap index is falling, very risky. Everything is falling right now. So it is my job to give you that disclaimer as well. So I hope you guys enjoyed this. And if you found any other multi-bagger or you found any other small cap company that has fallen a lot, there was one more, but I can't talk about it because I own it. But if you find anything interesting, please put it in the comment section below and I would love to interact with you over there. Okay. Thank you guys. This is me, Shashank Godapa, signing off. Take care. See you. Good night.